This is Wealth BT, a podcast of BT correspondents.
We're into March. There are renewed concerns about tariffs, and markets have been volatile trying to price in the impact of AI on software. Still, Asia is doing much better than the US. What investment themes can carry you through the year with stable returns? You may have heard of the barbell approach to investing. Can this work for you in getting returns and reducing risk? Welcome to Wealth BT. I'm your host, Genevieve Cua, Wealth Editor of the Business Times. My guest today is Hou Wey Fook, Chief Investment Officer of DBS. Wey Fook has had around 39 years investment experience, including more than 10 years in institutional asset management. Thank you for joining us, Wey Fook.
Yeah, welcome, Jen.
So let's start with your 4 or 5 strongest investment ideas or calls for 2026. What are they and why have you picked them?
The most impactful investment theme has to be AI. AI impact and influence on the world that is fast transforming into a digital or AI economy. Well, because AI will introduce what we call a bifurcated world, we'll see big winners as well as big losers due to the abounding existential risk out there towards traditional business models. So we think that would be the single most impactful trend. The other trends would be scarcity. In a world where there is abundance of fiat currencies, and as you would know, recently the Federal Reserve actually has discontinued quantitative tightening. In other words, going forward, they are again going to resume quantitative easing or printing of excess US dollars. So really, scarcity is a great theme because you are buying into assets with limited supply vis-a-vis fiat currencies with unlimited supply. So we do think that these asset classes would do well in the face of all this oversupply of fiat. Now, the third theme would have to be longevity. People are living longer as well as living healthier. The reason for this theme is because we think AI would really help accelerate new drug discoveries that would indeed lengthen life and health spans. There is, of course, winners in this space as well. The other themes would be Asia. I think Asia has been underperforming the US for the last 10 years or so. So as the US market becomes fully valued, we think there will be some outflow coming out of US. And because US is so big, 65% of the world index, Asia is 10% or so, a marginal reallocation of US will have a disproportionate impact on Asia. And we are starting to see that already. So we think this is, again, a theme that can last for another 12, 18 months or so. And finally, in our construction of a portfolio, we also seek after not just growth equities, but we also seek income generating assets because that's important to add stability to the entire portfolio construct. So bonds has been our call, the main expression for income generating assets, but yields have come down, I must say. Therefore, if you look around the world, where else would give you a very attractive income? It would be Singapore REITs, Real Estate Investment Trust. It's a well-diversified portfolio of REITs across the various segments of hospitality, commercial, industrial, retail, could give you 5 to 6%. Now, a lot of our clients are US dollar based. And if you swap that into US dollars, you are getting 7.5%, which is unbeatable, unmatched compared to all the other income-generating assets around the world.
I would like to take you up on scarcity because gold lends itself into that space. So can you talk a bit more about how you see gold?
Yeah, interestingly, if you look at the statistics coming out of World Gold Council, they estimated the above ground reserves in the form of physical gold bars, in the form of jewelry, gold bars and coins that are kept with central banks and long-term investors. The amount of supply of that is but the size of 3 to 4 Olympic-sized swimming pools. That's about it. So clearly it's a scarce asset class. And with all these escalating geopolitical tensions, there is a very strong underlying demand for physical gold, unlike just paper gold. So we have seen central banks around the world accumulating physical gold. And if you are an investor, you buy into the futures contract of gold, you could actually demand for physical delivery upon expiry of the contract. And we also see that taking place. So you have a situation now where COMEX and London Bullion Exchange vaults are also emptying out. So clearly these are tailwind for gold trading at a price we are today. I think we have been pounding the table on gold since it was below $2,000 per ounce. Today is $5,000. We think there is still tailwind just looking at the supply-demand dynamics.
Might you have moderated your bullish call, because of where the price is? Clients must be asking you, is it too high at this point?
Yeah, obviously to get in now may be a little bit more difficult than when it was prior. But really, if you look at this supply-demand dynamics, which is in play and in play for quite a while longer, especially when there is all this uncertainty over geopolitics. At the same time, central banks are reflating, cutting rates or keeping rates low and increasing money supply through quantitative easing. So these are very, very strong factors that would maintain the price of gold, if not cause it to go higher.
So, Wey Fook, when you speak to clients today, what are their biggest concerns? And what strategies you reckon can help them to stay the course?
Yeah, so clearly when we interact with clients, we look at their portfolios. They are very cash heavy. So it's not just with us, but across the industry, I would observe that clients are sitting on a massive allocation to cash in the order of 30% on average. And that's a lot to be sitting on 1-2% kind of interest rate asset class. And not surprising, what's bothering them is all these news feed that they've been reading about all these geopolitical tensions. And really, that's one big risk, I must say, and, would be President Trump's strategy or approach to international economics. I mean, he believes in zero-sum game. I win, you lose. There is no such thing as we both win together. So that, to me, is a source of constant volatility in the markets for this year and for the near future. So as a result, clients are sitting on a lot of cash, but that's not the right way to construct a portfolio. That's not the right way to maintain purchasing power. Inflation, as we all know, has been up. The Fed's target is 2%, but we are seeing 3 to 4%. So if you're just sitting on cash, then you will feel very much poorer in the years ahead due to inflation.
Cash, though, is quite tempting because it's very comforting. You feel like, I'm not losing on that end. Actually, how is cash harmful to wealth?
It's harmful because you lose purchasing power across all goods and services. Groceries, for example, we all feel it, right? Price of eggs, rice, and all that are just going up year upon year. And if you're sitting on cash at 1% yield, how are you going to afford the same amount of groceries? Of course, we would feel poorer, but I can understand why customers wanting the comfort of savings being preserved in terms of nominal values, which is why we did come up with a strategy. We call it Liquid Plus, which is really to extend the duration of cash deposits, which is mainly in the 3-6 month horizon to something like 2 to 3 year. So this strategy buys into, I would say, 2 to 3 year investment grade, which is a high quality credit. You get to pick up and you get to lock in yields over the next 2-3 years. So I think that would be one avenue for clients with a lot of cash deposits to migrate into. At the same time, enjoy that comfort too as well for capital preservation.
And it still remains liquid. Right?
And it's very liquid, because the underlying bonds are well traded. And the way we construct portfolio is we are highly diversified, not more than 1% per obligor or credit. So highly liquid, well diversified investment grade bonds.
Still to come. The barbell approach, as DBS Chief Investment Office sees it, puts growth and income assets on the two ends of the barbell. How can you apply this strategy and what risks and returns can you expect?
Lens on Singapore is now bigger and better. The same deep dive exploration of socioeconomic and geopolitical issues which impact our lives here in Singapore and the region is now a video podcast. If watching a conversation is your thing, join Clarissa Montero in monthly conversations about things that matter. Subscribe to the BT Lens On playlist in the podcast tab of the Business Times YouTube channel and start watching today. BT Lens On Singapore, now available in audio and video.
And now, back to Wealth BT, a podcast of BT correspondents.
Welcome back. Wey Fook, you've dealt with institutions, with retail investors, and also wealth clients. In your long experience as an investor and advisor, what are the most important principles to ensure success in the market?
The world has changed so much. I remember 40 years ago, since I started this industry as a manager of money, portfolio manager, the world was very different then. Today, the world is borderless, it's digital. If I'm sitting in Silicon Valley and I start up an app, the next day, my total addressable market is the world. And that has profound implications. So in the past, many portfolio managers would look at the world in silos. Is US better than Europe or Japan in terms of growth, inflation? And if it's so, then I will overweight or put more money in US. But with a borderless digital world, that's probably not the optimal approach, which is why we thought, in our mind very, very strongly that barbell strategy is really the optimal way. And barbell strategy to us is unique, which is really one end of the portfolio you buy into secular growth companies or equities, companies that ride on trends that are non-reversible and highly strong growth trends, like, for example, the AI economy. So that's the way to allocate assets. Now, once we identify secular trends, number one of which is the world becoming a digital economy, that has profound implications. Longevity, healthcare, that's another one that drives secular change. Once we identify the secular trends, we will then look into companies. And from that, we kind of build up into a portfolio irrespective of country of domicile, unlike in the past when it's just top-down. So we think this is the right way to pick the winners in a world that has so much of disruption and existential risk. And therefore, the secular growth side of our barbell has this strategy that we call, under this acronym IDEA, stands for companies that are innovators, disruptors. So in this world, buy the disruptors, not the disrupted. And then E are enablers, which are really semiconductor companies that enable the AI economy. And A are adapters. Adapters are interesting. These are traditional companies with traditional business models, but able to pivot into the AI economy. So they will also win big. Yeah.
Mm-hmm. I'm going to take a step back. When did you conceptualize the barbell? And in my mind, barbell means that the two ends are actually the larger allocations.
That's correct.
Is that how you see it? And because there are many different permutations of barbell.
So barbell really arose from the fixed income market, and it simply means you take two ends of the yield curve. At a very short end, 1-2 year maturity. At the very long end, 30-year, 50-year maturity. So of course, the 50-year maturity, 30-year maturity are more vulnerable, more volatile. The 1-2 years is a lot more stable. So barbell in that sense means you take the least risky and most risky. But we use the same concept, but we don't categorize barbell in the way a fixed income market would classify. To us, one side of the barbell of our portfolio is secular growth. These are capital gain compounders. If you hold them longer term, they will give you many, many fold of returns. A good example is NVIDIA. When we bought it 7 years ago in our portfolio, it's gone up 45x, and we are still holding on to it. Now, on the other end of the portfolio, we define them as income-generating assets because they actually will stabilize the entire portfolio because they give you constant income. Bonds will give you constant income. Dividend-yielding stocks like Singapore REITs will also give you constant income. So we do have that two ends of the portfolio with outsized positions. At the center, we would have up to 10% into what we call risk-diversifying assets, such as gold.
Oh, I see. Where does private asset?
So private assets come under different categories. Private equity, which really is part of the secular growth equity part of the barbell. So it could be expressed through public securities, equities, or it could be expressed through private equity funds. Similarly, private credit would be on the income side of things.
Can the barbell approach be mimicked by individuals on their own? Can they DIY this?
Oh, certainly. For someone who wants to construct the barbell portfolio, what they can do firstly is your risk high or low? Do you have investment time horizon in your hands? If you do not, then you want to have more on the income side of things. Now, for a balanced risk, I would say 50% on the income side, 40% into the secular growth equities, and 10% into risk diversifying assets. Now, how you can do it as an individual is, on this side, you could buy into bond funds, investment grade bond funds. You could buy into REITs, Singapore REITs, but make sure it's highly diversified. Don't just buy 2 to 3 REITs, but buy 10, 15 very high quality Singapore REITs across the various sectors. In any case, the total return on REITs is primarily through dividends. Therefore, you don't want to take concentration risk because you're not paid for that. So really, that part of it should give you stability in terms of cash flow. So you could do that on your own. And on the growth side of things, you could buy into technology funds, for example. You could buy into healthcare funds with a focus on innovation so that you can participate in the drug discovery potential as a result of the proliferation and advancement of AI.
How well has this done for your clients?
Oh, fantastic. So that's a great question. This strategy has been launched 7 years ago. We actually created a real-life fund, which today would have about $10 billion under management directly by us. The efficacy of this strategy has been demonstrated. So in the last 7 years, there were 3 occasions of a pretty sharp drawdowns, peak to trough, averaging 30% in the NASDAQ index. So of course, we had COVID. We had 2022 on the back of the Fed raising rates by 500 basis points, and we had Liberation Day. On average, 30% peak to trough. But if you look at the performance of this barbell strategy, we gave a return of about 8.6% annualized on a net basis. So I think it's been proven resilient, in the face of all these strong drawdowns.
Thank you, Hou Wey Fook, for dropping in and sharing your insights.
Yeah, most welcome, Jen.
On this podcast, we hear about various approaches to portfolios like staying balanced in a mix of stocks and bonds, the core satellite approach, and now there's the barbell. You could put a barbell approach together, as we've heard, using low-cost ETFs, investing in technology and growth, for example. And for income, you could pick some REITs or dividend-paying ETFs. But the important thing, of course, is to take the risk that matches what you can tolerate, your time horizon, and goals. This ensures you can stay invested long enough to reap the rewards of compounding. BT Correspondents will be back next week with an episode on transport. Until the next time, I'm Genevieve Cua. Thank you for listening.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.